A lot of people are in trouble, as you alluded to earlier. Interest rates have doubled. Insurance has doubled in many states, if not tripled or 10x for some properties in Florida. And people have to do capital calls. How would you approach doing a capital call? And maybe from an investor's perspective, if you would like to talk about that, how would you maybe choose to participate in that or not?
Yeah, so the first thing I would
advise, this is not legal advice.
Yeah, no. The first thing we typically advise just client, this is just good practice for everyone. And I got this from my buddy Ken McElroy, who said this many years ago. But when things aren't, so this actually happens before the cash call. When things aren't going well and things are starting to just not go according to plan, because cash calls don't happen from one day to the next. It's not like everything's going great on Monday and then by Friday we need a cash call, right? So things are going to slowly start happening. And the key is to make sure that you double down or triple down on your communication with your investors. A lot of syndicators, especially new ones, tend to sort of stick their head in the sand a little bit and they're like, things aren't going well, the investor's going to be upset at us, and we should not tell them. You want to be, if you're communicating once a quarter and things aren't going well, maybe you start communicating once a month or once a week or every day, or depending on how severe things are. That way, when it's time to do the cash call, it's not a complete shocker. You've slowly been showing, look, this is what's going on. It's been a tough environment. We need a refinance and we can't because the interest rate's gone up and our rate, whatever the situation is, letting them know earlier. I think the investors appreciate that. They may not be happy. I'm not saying everybody's going to be like, oh, you communicated, everything's great, but trust me, you're going to be in a much better situation doing that than sticking your head in the sand and then just throwing out a cash call and then just, doing, things like that. So that's step number one. Step number two is, generally speaking, the really great syndicators that have been doing this for a while generally try and avoid a cash call at the beginning. Usually if there's the inclining of issues that happen, let's say, rents or revenues down because of whatever reason, then the syndicator generally will the first line will be them. So they'll make a loan to the company. It's usually in the form of a loan, but they'll do a capital contribution into the project. Number one is a show of faith that they're confident in the project. But number two, the cash flow is kind of the last thing you want to do. And so generally speaking, the sponsor group as a whole, they're shelling out whatever it is they need to patch it, and hopefully they can get from point A to point B and things can turn around before having to go to the investors. So hopefully by the time you've gone to the investors, number one, you've been communicating with them, but also you've already infused some capital in there, and now you've used up that capital. Maybe your team put in $500,000 because you needed that as a deposit, and that was 3 months ago or 6 months ago, and now it's like, well, we need another 500. Now we have to go to the membership to get the 500. First step for both syndicators and for investors is you want to look at the operating agreement. I get calls from clients all the time that say, hey, I need to do a cash call. What do I do, or how do I do it? That's going to be in the operating agreement. There's going to be a section in the operating agreement called cash calls, or probably something more professional called additional capital contribution. There's going to be a capital contribution and additional capital contribution provision in there, and it's literally going to outline how it's going to work, and how whether it's mandatory, whether it's not mandatory. Now most of them are not mandatory because, let's face it, if you were going to raise money and you said investors want to be able to just write you a check for 50 grand and know that's all they have to contribute, so we wouldn't recommend drafting documents where they were mandatory. But there are going to be some what we call dilution provisions, which is if they don't contribute to the capital, then depending on where they get the capital from, your 2.5% ownership in the company might go down to 2% or what have you. But those step-by steps are going to be outlined in the operating agreement. What we generally do, I think ours are written in the sense that, obviously you figure out how much money you need. Let's say you needed 500,000. And so you go out and say, look, we need $500,000, and you're asking every single investor to contribute their ownership percentage of that money. So if I own 2% of the thing and we need 500, then you're going to give me 2% of the 500. I would probably request as a syndicator a little bit more, because you're never going to get 100% compliance, even if everybody's super happy. So if you need 500, you may probably want to ask for 750 or something. So that way, if 70% of the people say yes, you get to your 500, but it's going to be proportional. And then if you're short is where you really want to pay attention to the operating agreement. So our operating agreement actually allows us for other members to contribute additional. So if, let's say my cash call was $5,000, I could contribute 10 or 20, I can contribute more as almost like a loan on behalf of another member that didn't want to put in the capital, and I basically have a lien on their shares. So that way, if the project turns around, or when the project turns around, when distributions start picking up again, the person who did not give the cash call, those distributions would be diverted to go pay off the loan that the other member gave on their behalf, right? But unfortunately, what happens a lot of times is you're still short. So you put in money yourself, you've gone to the membership, and they don't want to, or you're just short. You needed 500 and you were able to raise another 200 grand from your membership. You're still short. And unfortunately, if you can't come up with the other 300, there's a chance you may lose the property, right? So everybody loses all of their money. And so that's when you start going outside of the membership, which is really where the dilution happens, especially if you're desperate enough that you're going to bring in a private equity group that may want to come in. Especially these days, there's a lot of funds out there that are really targeting. So they might come in and say, look, I know you need 500. I'm going to give you the 500, or I'll give you $1 million. But then they insert themselves way ahead of everybody else. I mean, obviously the lender, the bank's going to be number one always, but then they're going to be second, and they're going to have their money out before any of the LP money comes out. Or maybe you get a loan. Maybe there's another party that's interested in loaning you 500,000, and you're going to pay them a really, depending on how the situation is, it might be a high interest rate. It might be a 15% rate or 20% rate or whatever it is. At that point, it's whatever the managers can negotiate. I mean, obviously the deal's not going well, so it's not like it's a super attractive investment under normal circumstances. So you're going to have to sweeten the pot to anybody that comes in on the outside in the form of preferential treatment or higher returns or something like that. And of course, if that doesn't work, then you get the dreaded, the foreclosure letters, which are starting to come out, which are the sponsors basically letting their investors know, hey, the cash call didn't work, meaning we didn't raise enough money. We couldn't raise money from the outside. So unfortunately, the bank is going to be taking over the property, which, as you know, Stephanie, has been happening a lot. I don't know what the specific numbers are, but especially, I mean, there's people who bought, let's face it, there's people who syndicated and bought properties in 2021, which is about the peak of the market. And so
4.5 caps.
Yep. And so those people who bought in 2020 or 2021, the issue is that a lot of those operators, and this is no knock on the operators, because not everybody, but the vast majority of people doing it, because of the way it's really not so much the interest rate. What happened was the property values were going up so much, and the rents weren't keeping up. This is really pre-COVID. So what happened is that the operators were buying at really high prices, and then the rents weren't keeping up, and so the debt coverage of the income wasn't covering the requirement that the lenders had. So I had a bunch of people on my podcast, Stephanie, that were talking about, I thought, hey, they're just not lending money. The banks don't want to lend. They think it's already frothy. And they were telling me, no. If you can bring a deal to them that actually cash flow sufficient to cover their debt coverage ratio, which is usually 1.25, then they're happy to loan you 80% or 70% or whatever. But the problem is the properties weren't cash flowing enough in relation to the value of the property. So the loans they were offering back in 2020 and 2021, traditional conventional lenders, were literally 65% LTV or 60% LTV, really low LTVs, where the returns really just weren't penciling out. And so the vast majority of syndicators and operators moved over to what we call bridge loans, or shorter term loans, which were more in the 3-year range, right? And so a lot of the properties that were bought in 2020, 2021 were bought on 3-year loans. And those loans, of course, are coming due right around now. And as we all know, interest rates have skyrocketed from whatever they were back in 2021. And you probably get a loan for 3.5% on the commercial side, probably 4%. And now those are at, you know better than I am, probably 8% in terms of the commercial. So they just can't refinance right now, right? So they need to go in, and their loan is up. They can't refinance. And so they're forced to sell. And if the property's down 20%, then there goes all the LP money. I mean, the LPs generally you're putting down 20, 30%. So if your property goes down 20%, that wipes out 100% of your investor money.
I heard some properties were down 50%.
Yeah, so that's a great point.
My heart goes out to everybody.
Yeah, I mean, as we all know, there's really no such thing as a U.S. real estate market, right? Every market is localized. So some markets are doing still pretty good. Some markets have dropped 30%, 50%, and other markets have dropped a little bit, and depending on the asset class too. I mean, as we all know, when I say commercial, office buildings, commercial real estate involving office has really taken. I mean, some of those are down 80%. You and I have spent some time in the San Francisco area, Stephanie. Those properties are selling at 30 cents on the dollar. But then there are other markets that are super resilient and they're still maybe only down a few percentage. So it really depends on what market you're at and everything. But yeah, I mean, if you bought in 2020, 2021, your loan is coming due and you can't refinance because your property's down 50% or 30% or 20%. That's a problem. And then, of course, you mentioned the interest rate going up. What most people were doing is because interest rates were going, they're all floating rate debt primarily, that you typically would buy an insurance product in order to protect yourself from the upside. So if you bought the property at a 5%, interest rate, and you would buy an insurance so that makes sure that if it ever goes above 6%, that you're covered, that the insurance company will pay you anything above that. As we know, interest rates have now pretty much doubled since maybe 18 months ago. And so those insurance premiums are coming up for renewal, and that's a lot. Not as crazy as it was maybe 6 months ago, but 6 months ago, I remember if you needed to renew, the banks were requiring you to renew these insurance policies, and you had to go do a cash call just to cover the insurance premium of your insurance policy. And then the lenders wanted more protection themselves, and they wanted you to escrow a bunch of money in an escrow account, which again, you didn't have. So a lot of the cash calls aren't even necessarily that the product or the property isn't spitting off enough cash. It really has to do with these additional requirements of the lender wants me to put another year's worth of rent in escrow, and my insurance, my rate caps have gone through the roof. I mean, they really were, I don't want to say grotesque, it's not the right word, but they were really crazy in terms of what those rate caps were going for. I think they've come down now because I don't think too many people are expecting interest rates to double again, right, from where they are now. But you never know; they could still go up another 2%, and if that starts killing your numbers, it starts killing your numbers.
You never know on anything, right? And we should account for a black swan in your deal at all times, because first it was COVID, now is interest rates doubling. Who knows what the next one will be? It's something we cannot predict, and that will likely happen as well. So we all must be mindful of that. Mauricio, this has been incredible. Thank you so much. Besides meeting you next week and hearing you present at our summit, how can our listeners get in touch with you?
You can find me on the website, which is premierlawgroup.net. And I'm also super active on LinkedIn. So if you want to look me up on LinkedIn and follow me there, I put out content pretty much every day. And of course, a YouTube channel. I've got, 200-300 videos. I think I've covered pretty much every single syndication topic out there. So if you guys have more topics, maybe drop a comment somewhere in the YouTube videos and I'll make one. But just the YouTube channel, Mauricio Rauld, is another great way to find me.
And as always, all of these links will be under show notes. The YouTube videos are actually very helpful. Mauricio, thank you so much for coming over. I really appreciate it.
No, thanks for having me, Stephanie. Looking forward to seeing you next week.
Same here. Thank you.